Hello and welcome. You're watching KYC, which is Know Your Company. It's a show where we're going to take you through today. The company is Tega Industries. Interesting one, established in 1976, headquartered in Kolkata. It offers a wide range of abrasion and wear-resistant lining components made of rubber, polyurethane, as well as steel and ceramic components. So infra is essentially the play here. They have 10 manufacturing facilities, so quite a large setup in terms of their manufacturing as well. In terms of where they are on the market cap front, around 10,500 crores in terms of market cap, and trading at a price to earnings ratio of around 62 times. Domestic, smaller relatively, 25%. The geography mix more tilted towards international. 75% of their mix comes from international. So that's the setup on Tega. But as we always do, let's quickly look at the factors which influence decision making of investors. And the first off we'll look at is income statement. Then we look at order book position for this one, more linked to infra. Balance sheet check. We'll also look at return ratios. Thereafter, we'll look at the cash flow, the shareholding, the street cred, and the street coverage, as we always do for most companies. So we'll be good breaking this down. Tega Industries. Have with me Anushi joining, who covers infrastructure quite extensively, and therefore we'll be good breaking this down. Anushi, let me allow you to start with the income statement. And also the order book position for the company. Please give us perspective.
Right. So we spoke about Tega. One just quick point that I wanted to mention, that it is mainly into mineral processing, screening, grinding, and material handling business. That is, there you spoke about the 10 manufacturing facilities. Now, if you look in terms of revenue, 3-year revenue CAGR has been on a strong footing, at 23% of a growth. That is what we are looking at. In fact, let's see the FY22 to 24 figures if we can. The revenue growth from 22, it was 18%, then 27% of growth in 23 and 23% of growth that we are seeing now in FY24. Margins have more or less remained in the 21 to 22% of range, and the management has indicated that they continue to do so in FY25 as well. Net profit, with what stood at about 116.9 crore in FY22, is now standing at about 193.8 crore as of FY24. But let's get the first half perspective as well. The first quarter, we saw some large orders that had spilled over in the revenue of that, which led to a growth. But in Q2, there were some deferments and some delays, which resulted in a downtick. So overall H1 picture, if you look at, we saw about a 7% of a revenue growth at 693.3 crore as compared to 645.5 crore last year. Margin stood at 14.2%, so a considerable downtick from what we discussed in the FY21 to FY22 to 24 picture. This is in comparison with the H1 FY24 figure of 18.8%. Net profit saw about a 36% of a downtick. So this is the income statement check that we are seeing for the last 3 fiscals as well as the first half of this fiscal year. As far as where the order book positioning is, order book stood at about 605 crore. This is as of the September 24 picture that we are seeing. But we are not considering large term orders like the NMDC order. That is something that we have to take in account for. So yeah, so that is the overall order book and the income statement check that we have in the business.
Okay, so those are 2 factors that we've looked at. Let me move on to the third one, Anushi. Let's look at the balance sheet. Now, the balance sheet looks decent. You're looking at 1251 crores of equity plus reserves. You're looking at borrowings, which is a small fraction of that equity. You're seeing around 107 crore worth of borrowings on the balance sheet. The short-term borrowings are around 112 crore. The payables, which stood out for me because your short-term borrowings were 112 crore and your payables were 180 crore. And therefore I've highlighted that as well. So some of the short-term current assets current liabilities look slightly inflated in that sense, which is why I've highlighted it. Payables, 180 crore rupees worth of payables currently sitting, as I did mention. Now, on the current assets side, important to analyze that as well, given that we've analyzed the current liabilities. We're looking at inventory of around 401 crore and cash balance, which also looks decent at 96 crore. So healthy overall in terms of its balance sheet. Borrowing is far and few. And of course, the segment that it operates also is niche. So difficult to compare this with other players in similar sectors or in a very similar sector. And therefore, going to be difficult to determine whether this is materially adverse, but at least right off the bat, when you're looking at some of those numbers, they don't look bad at all. Equity reserves of 1251 and borrowing of just about 100 crore. So definitely a healthy balance sheet. Let's also look at the return ratios we're working with. You're looking at the last year or so, return on capital employed of around 19%, and that's been the band in which they've worked with. Over the last 3 to 5 years also, they've been in the 17 to 19% kind of band where return on capital employed as well as return on equity is concerned, and therefore healthy return ratios. Anything in the late teens, definitely a positive where return ratios is concerned. But the other important metric to track is cash flow. And Anushi, why don't you break that for us?
Right. So we'll talk about cash flows from what has happened from FY 23-24 and as of September 24, what figures we are looking at. If you look at cash flows from operations, what stood at 178.5 crore at the end of FY 23, that moved to 252 crore as of FY 24 end, and now subsequently around 113.5 crore is the figure that we are looking at. So overall, a decent amount of net cash flows from the operating side, that is what you're looking at. But if you look at the net cash flows, do note that the company has taken and is also taking a lot of capex. This is for a lot of projects in consideration. This includes the Shile plant and the Dahej plant as well. So do take that into consideration as well. If you look at the net cash flows, that stood at about 7.74 crore as of FY23 end. Which increased to 46.2 crore as of FY24, and currently it stands at about 3.02 crore. That is the cash flow picture that we are building for the company. Dividend payout, if we are seeing the dividend yield, stood at about 0.1%, and payout was about 7% of the profit figure that we had. So this is the cash flow and the dividend picture that we are looking for the company. But let's also talk about the shareholding, Harsh.
Yeah, so interesting that you bring up shareholding, because it's a deeply concentrated shareholding where promoters are concerned. You're looking at 75% promoter ownership, and therefore very, very healthy in that sense. In terms of consistency of promoter ownership, and that's something you would always want to look for. It's fallen just a wee bit from 79% to 75%, and thereafter it's largely been between 74.5% to 75%. That's largely the promoter ownership. Where FIIs are concerned, they've sold a bit of the counter. They clocked a high in terms of their ownership in June 2023 of 2.5%. Currently sitting at 1.8% is the FII ownership. The DIIs also have not exactly sold, but have in fact gone ahead and bought this counter in a big fashion. 9% was the DII ownership in March of 2022, currently sitting at 19%. And it's a phased kind of increase in terms of their shareholding as well. So it's an interesting kind of chart in terms of the way shareholding has evolved. You're also looking at public, which holds now just about 4% of the company. The number of public shareholders have compressed quite dramatically. The total number of shareholders at the start of calendar year 22 was around 127,000 shareholders, which currently is just 53,000 shareholders. So the number of shareholders has come down quite dramatically. But your promoter ownership is healthy, Anushi, and that's one thing you want to look at. And the other thing is your DI ownership has gone up. So there's some bit of comfort where shareholding is concerned. So definitely a thumbs up on this count.
That was quite interesting that you've laid it out as far as where the DII and the promoter holding goes and how the public has played into the picture. But let's also talk about how it has performed on the street. Now, in the last 6 months or so, we have seen a bit of a downtick as far as where the stock performance goes. 8% of a downtick, but the long-term picture, if we see, it has remained on the healthier side. 36% is what their one-year share price return was. And if you take the 3-year stock CAGR, that stands at about 39%. So a healthy growth in terms of where it has been doing for a long-term perspective side. That is reflected by the kind of fundamentals that we had discussed earlier on the income statement and the balance sheet check that we had done. So yeah, that is the street cred on how it fares. So this one is a thumbs up.
Right. So street coverage now, because that's important, because when you're looking at governance, typically the number of analysts which cover a stock will tend to give you more comfort that it's a well-governed company. Here there are 5 analysts covering the stock, so reasonably less in terms of the number, but 80% have a buy call and there is 29% upside with regard to where the upside is concerned. So one is analysts are constructive overall with regard to the company. They're positive on the company, but just about 5 analysts covering the stock, and therefore we've given it a bit of a neutral rating here, because the breadth in terms of the number of analysts covering the stock is very, very low. But in that sense, there's also some bit of positive bias with regard to the fact that 80% have a buy call, which is 4 out of 5 analysts, and there's a 29% upside to it. But more importantly, FY25, what's the outlook that they've given for FY25 and beyond? Anushi.
Right. So we spoke about the FY22, 23 and 24 picture, and we saw more or less about, if we go back and check the figures, we saw about 27 to 23% of a growth in the last 2 fiscals predominantly. The management for the FY25 scenario, they have built in a revenue target growth of around 15% for this year. Now do note that in the H1, they had clocked in about 7% growth. This was in Q2, there was some deferments and delays in orders that we should definitely be addressing. So revenue growth stands at about 15%. EBITDA margins, if we see in the blended range, that will remain in the 20 to 21% as before that the company has been posting about. What we should be understanding is on the outlook on the certain delays in shipments and deferment of orders that took place in Q2. If there is an improvement from this level, from the next half onwards, what is the scenario that we should be building up for that? And EBITDA margins last quarter had taken a hit. This was due to a contract accounting related change, which led to a one-time expense of around 17 to 20 crore. So margins would also be something that we should be focusing on. But what is interesting is the project updates that we have. The Tega McNally integration is on track. How that would fare for the equipment business growth for the future, that is something we should be watching out for. Construction of the Chile project has commenced. The commercialization target in Q1 or Q2 of FY26 is something we should be watching out for. The capex drive for the same is in the range of $35 to $40 million. This is including the Chile and the Dahej plant. So a lot of factors in consideration. Huge road for capex as far as where the Chile project is and how this would lead to incremental revenues for the business.
Right, let's, so interesting, and we'll try to cover some of those in our conversation as well. But let's quickly pull up the assessment of all the factors that we've already looked at. Income statement, check, definitely positive. Growth has been very strong. Order book position slightly muted in that sense. Balance sheet check, very, very solid in terms of how the balance sheet is lining up. Return ratios are well in the late teens and therefore positive. Cash flow is a neutral. Would want to see some bit of growth on that count. Shareholding is a positive. Street cred is a positive. And street coverage is again a neutral because of just not enough breadth available in terms of that street coverage. So it's a 6 on 8, a healthy one in that sense for Tega Industries. But let's try and break this down, get more perspective. Let me welcome on board the management, Mehul Mohanka, who is the Managing Director and Group CEO at Tega Industries, to talk to us about how the company is expected to fare going forward. Welcome, Mr. Mohanka. First off, I want to understand how business environment is evolving. What's the kind of growth clip you're targeting, just for perspective of viewers? What's the kind of confidence you have to meet those targets?
Morning. Thank you for having me on the show.
Good morning.
From our perspective, as you know, that our business is in the critical to operate consumables business in mineral processing. So for us, we're quite delinked from where the commodity prices are at any given time. And our mainstay ores are copper and gold. So those still remain quite healthy in terms of pricing if you look at and the growth vis-a-vis FY24 over 25 in terms of prices of the commodities. So we still stay bullish in terms of our growth prospects. And as we had mentioned in our previous earnings calls as well, at the end of the second quarter, that we maintain our predictions of a 15% growth over the previous year for this year as well.
Hi, Mr. Mohanka. This is Anushi joining in. You've talked about maintaining a 15% of a revenue target for this year. Want to understand, this is the FY25 picture that we are seeing, but from FY26, the Chile plant commercialization will begin. Expect incremental revenues from there on. So for the next 2 to 3 years, if you want to build perspective on what is the kind of growth that we can expect, because we are looking at incremental revenues at the size of 800 crore, if I'm not mistaken, as per our last conversation. Can you indicate the revenue growth from these levels from the FY24 picture, if you can see for the next 2 to 3 years?
Yeah, so the Chile plant will take about 2 to 3 years to completely ramp up. It's not that we're going to be at 800 crores incremental revenue from year one. So that's the installed capacity of the plant, and it'll take us about at least 8 to 10 quarters to be able to get there from the time we commence commercial production, which will be around FY26.
Okay, so in terms of how much of that will come on stream in FY26 versus FY27, what's the sense like?
So we would expect anywhere close to about 40 to 50% of that coming on stream in FY26 and the balance in the subsequent years.
Okay, so that is the outlook for the growth perspective from the Chile plant that we are looking at. Now, Mr. Mohanka, I want to break up the H1 performance and the H2 performance that can be anticipated. Now, in H1, the first quarter, we saw some strong set of numbers in terms of revenue. There was some spillover, while in H2, there was some delays in terms of where the ordering and the shipping related challenges were there. How is H2 building like? Are we seeing some bit of improvement from these levels? What would be the margin scenario? Because in the second quarter, we did see about a one-time expense also impacting the margins that were there. So 20 to 21% is the range that we should be looking for FY25?
Absolutely, as I mentioned earlier as well. So we're maintaining our growth estimates as well as our margin estimates. So EBITDA would be at north of 20%, and we've always guided the markets accordingly. So the one-off adjustments have already taken place in Q2, as we mentioned earlier. And while there continues to be some delays on shipments, but they're on track as far as our growth estimates and guidance is concerned.
Okay. So would it be fair to say that FY27 will see maybe 400 to 500 crore rupees of incremental revenue over FY24, and thereafter the full 800 crore ramp up will happen, and across the board you'll maintain 20% plus margins? Is that the right way to look at the next 2 to 3 years in terms of just trying to sum everything together?
Absolutely, and also to further mention that we do have also some incremental capacity expansion happening in our plants in India as well. So that will also play out by FY27.
And how much would that contribute to top line, Mr. Mohanka?
So it's a small capex that we're doing in India, and that should bring in about another 200 odd crores of incremental revenue growth for us.
Okay, and with regard to all the capex that you're doing, all of that is internally funded, because I don't see much on the borrowing side. You seem to have a decently clean balance sheet in that sense.
Yeah, so we're a cash surplus company, so we have very low leverage, as you've seen on our balance sheet, and we've got to continue to maintain a healthy mix of debt and equity. So most of it will be funded through internal accruals, and we will also look at some debt options from a tax gain perspective.
Fair point. And does this therefore mean that your cash flow, which you're going to be using to fund fresh capex, how much of that capex is expected over the next 2 years? Because you seem to have front-loaded a large part of the capex over the last couple of years.
So our total outlay over the next 2 years will be close to about $40 million. Basically over Chile, India expansion, and some maintenance capex. So our maintenance capex tends to be about anywhere between $4 to $6 million a year, and the balance of that would be on capacity expansion in Chile and India.
And that should leave you with a considerable amount of free cash flow as well. In your books, what do you do with that cash?
So we're going to use the cash mainly for further expansions. I mean, this is not the end of the road for us from a capacity perspective. So we do expect the market to continue to grow, and we also look at other opportunities from an inorganic perspective as well. So this will be a great war chest for us for future or inorganic plays as well.
Okay.
And anything above and over that stays, we'd be happy to give it out as dividend to our shareholders.
So that is as far as where the capex and the cash flow pictures goes for the business. Now I want to come to your order book. Your current order book stands at about 605 crore. This is as of the September figure that we are looking at. From here on, what is the kind of picture that you build for the order inflows expected over the next 2 to 3 years? If you can get a sense on the total order book, and what is usually the execution timeline like? This is excluding the NMDC order that I'm talking about. So if you can give a sense on the NMDC order as well as the current order book that you have.
So as of September end, as you rightly mentioned, it's about 605 crores. This is over and above the project orders. So we haven't accounted for that in the 605. Our normal execution time for non-project orders is about 3 to 4 months. So that's the order to cash cycle for us. And from a quarter to quarter perspective, maintaining a 15% growth, if you do the math, we would expect a good order book of about 700 to 800 crores per quarter at any given time.
Okay, so that's on the perspective of order book. Now I want to understand more on the segment performance. Also, you have divided your business in the in the two verticals that you have, which is the consumables and the equipment business. Now, equipment business, the Nelly integration is on, Tega Nelly integration is on track. I want to understand the future prospects of that one. How do you plan to lever that for the business going forward? What is the kind of mix that we should be looking forward, as right now the consumable side is the dominant one? So can you give us more perspective on the equipment side of the business as well?
Yeah, so consumables for us is dominant from a size perspective, but we see and anticipate that over the next few years, the equipment business will always also have, from an absolute perspective, a dominating position as well in terms of our total revenue mix. So our equipment business is also expected to grow at a CAGR about 15%, 15 to 20% going forward. McNally's been a one-year-old vintage for us as of now, and we are still busy trying to integrate the business. It's progressing well for us, and it's going to be our future growth bet going forward. So the equipment business for us is a backward integration, and it helps aid the consumables business as well. So from a strategic perspective, we are very, very bullish about how the equipment business will play out in terms of our growth story going forward.
So will that lead to any sort of EBITDA margin expansion also? Because last time you had indicated that there's some 200 to 300 basis point of an improvement that we can look from that side of business also. So the 20 to 21% of the margin picture that you have for FY25 from 26-27, if you want to see, what is the kind of uptick that we can expect?
So the equipment business and the consumables business will always have different margin profiles, So the equipment business, which is more capex oriented, will be at an EBITDA margin of anywhere between 13 to 14%, while the consumables business is always going to be around 22 to 23%. So that's the difference in the margin profile. So in absolute terms, I would say over a period of time, the EBITDA contribution would be a higher number from the equipment business, but from a percentage perspective, it will always be more muted compared to the consumables business.
Mr. Mohanka, for our better understanding of your business, talk to us about what your clients are like. How do demand cycles work for you? And what are the risks like in terms of demand? Because currently you're anticipating, or at least it seems like demand is strong. How does one judge a cycle in your line of business?
So all our customers are major mining companies across the world, globally. So as you know, 85% of our revenues are generated outside of the country. And these are mining majors such as BHP Billiton, Anglo, Barrick, Newmont, Vedanta, and the others. So any major mining company, junior mining, mid-range mining companies, and large mining companies would be our customers. And it would all depend on the output or the tonnages that these mines are processing on a yearly basis. And as I mentioned, these are critical to operate products that we manufacture. Those mines cannot operate, or they cannot extract the metal from the ore without products that we manufacture.
Right, so absolutely critical, and my guess is it's commodity linked. Is that the right way to look at this?
Not at all. Like I said, as long as the mine's operating, they need our
Fair.
product. So it's not really
Fair.
linked to the commodity price.
Fair, fair, fair. Okay, Mr. Mohanka, I'm going to have to let you go on that note. Thank you so much for all of that perspective that you've given us today. Thanks for coming in and speaking with us.
My pleasure. Thank you so much for having me on the show.
Right. So that was the management of Tega. We've spoken about Tega. I think we've broken it down, and hopefully this was valuable to you. But from Anushi, myself, everyone who puts the show together, thanks so much for watching. This was KYC, and we focused in on Tega. But with that, out of time on this edition of the show. Stay tuned to NDTV Profit. More action on the other side.